stock of the day, which is a stock I always throw in, that's in the news, Bank of Queensland. Shares under pressure today as the lender flags continued pressure on revenue and margins, as well as increasing risk into FY24 due to the elevated cost of living and higher interest rates. This as it posts a 70% slide in full-year net profit to 124 million. Net interest margin, 1.69%. Revenue slightly higher at 1.76 billion. Cash earnings at 450 million. Dividend cut with 21 cents a share payout declared, down from 24 cents a year earlier. Michael Wayne, is this a precursor of things to come for the banks?
Possibly. They've all sort of flagged the increased competition that's out there. So although they are getting a bit of a tailwind in their favour from the rising net interest margins, competition's high at a time when credit growth is low. If you look back to sort of the early 2000s in this country, credit growth was well above sort of 15%. These days, it's more or less, between 5 and 7%, and it's been trending lower, as you can imagine, with interest rates higher. Borrowing capacity is lower, so it's harder for people to keep taking on more debt in a higher interest rate environment, not to mention people are already fairly indebted. So it's difficult to see how these banks continue to grow earnings, grow return on equity, grow dividends in this kind of environment. And it's probably been like this for a while, but it's even getting more challenging for them, particularly when you consider they've got to take on a lot of capital expenditure, improve their tech networks and infrastructure. So I'm struggling to get overly excited by the banks in this environment.
Right, all of them, not just the regionals?
And then regionals are even less so,
right.
Just given the fact that their cost of funding's higher, the competition's intense, their margins tend to be lower, and their diversification of client base and mortgage book is also inferior. So I'm not excited on my end.
So you wouldn't be looking at them if you're in them. Now, depending, a lot of people have been in there for a long time, so it depends on the tax situation, all that sort of stuff playing into it. But if none of that played into your decision, would you be switching out of banks?
I would be selling out of Bank of Queensland, definitely. Right. Also, banks in general. I mean, we've had clients with very low market or very low portfolio weightings relative to the market for a number of years. We don't hold any banks in our managed funds. Obviously, some clients do, given that long-term exposure. But in the case of Bank of Queensland, I doubt you've got many capital gains, to be honest. Yeah. And the fact of the matter is, most of the attraction from banks, in our opinion, is from a growing dividend. Yeah. And the dividend per share has actually been falling for a lot of the banks. So you look at, I've gone on about this a couple of times, you look at what you can get on a bank bond, Commonwealth Bank bond with 3 to 5 year maturity, you're getting 5.5%, 6%. Right. When you're getting dividend yields of 4% in the case of CBA. So I just don't think the risk rewards are attractive at the moment.
Okay, because it used to be the old adage, Francesco, that it was always better to invest in bank shares than any products that they offer their clients. Not so much now.
I wouldn't be as negative. Look, Bank of Queensland, our analyst is a little bit positive, and I'd be probably more neutral on Bank of Queensland. So if I owned it, I'd hold it. Right. I wouldn't be rushing out to buy it at this point in time. Yeah, look, dividends have fallen, and look, the dividend they announced was a cent below what our analyst was expecting. Earnings per share was about 6% below where our analysts were expecting. So it's missed the mark. So I wouldn't be surprised if the analyst overnight adjusts his recommendations. But I think across
just for Bank of Queensland or across the board, do you think?
Probably just for Bank of Queensland at this stage. Our house tends to be fairly neutral on the bigger banks or to positive on the bigger banks, just because of the nature of conservative clients tend to hold a large part of their portfolio in the banks. I agree with Michael. Look, I think we're at probably top of the cycle, net interest margins. We've seen rates, cash rates rise. Banks tend to obviously move on the loan products more than they do on deposit products, so that gives them that interest margin opening up the jaws. But we'll probably see rates start to slow down a bit, if not flatten out, and then the next maybe in a year and a half's time, it might be downwards. So the market's trying to look ahead
Right.
to where those rates are going. And as Mike said, there's not a lot of growth in lending at the moment. I think we'd have to see the property market settle down a bit before we start to see anything go on there. So I'd be neutral if I owned it. I wouldn't be chasing buying it though. But the share price moving down, always makes it look a bit cheaper, but it might get a bit cheaper again.
Yeah. Sometimes it looks cheaper for a reason, does it?
It does, yeah.